Investment advisory services are offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. This is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any mentions of rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing company, not guaranteed by any bank or the FDIC. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean that the advisor has achieved a specific level of skill or ability. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal or tax advisor to be sure a Roth IRA conversion fits into your planning strategies. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.
Coming up today, how to identify the retirement planning concerns that matter the most, tips to help you along the path in your retirement road, and questions to be asked and answered before you drive off into the sunset.
And now, how to retire with Fuchs Financial.
The main thing for the majority of the listeners out there who are approaching retirement is I don't want to be surprised.
Helping you build, preserve, and manage your wealth.
You got Roth IRAs, you got individual accounts, and finding the right taxable strategy, that's going to be huge for you.
Welcome to How to Retire with Ben Fuchs.
Riding into the sunset with your gold watch. How nice would that be? Yeah, we're going to explore that today on the show. Hi there, I'm Gary Nolan, your consumer advocate. With me is Ben Fuchs. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years experience. And the show is How to Retire with Ben. I know that, Ben, that's your goal, to ride off into the sunset. That's what you want to do, right?
Yeah, but that also brings conjures an image of that movie where the two women are driving off into the sunset over the cliff, and I think it's Gina Davis. I don't think that's what we want for our retirement goals, but you know.
Thelma and Louise, I think that was it. Yeah,
that's
exactly.
the one. Yeah.
So no, we're not going to have you drive off the cliff. We don't want you to do that. So anyway, let's get going. So the economic landscape has been challenging Americans in more ways than one. Trying to gauge and forecast the Federal Reserve's interest rate adjustments when inflation is beginning to lift or the market ebbs and flows can feel overwhelming, particularly when you're saving for the financial future you want. So let's start with this, Ben. What are your thoughts?
Yeah, Fidelity's 2024 State of Retirement Planning Study, over half, 54% of the Gen Xer and Baby Boomer respondents expressed concerns about higher cost of living. And it's difficult because, yes, trying to gauge when the Federal Reserve is going to raise or lower rates, it's difficult. But I said it earlier in the year with you, Gary, that I did not expect this massive rate cut. I mean, at the end of last year, there was this, I would say, intense optimism that they were going to reduce rates 5 or 6 times throughout the year. And I never once expected that or projected that for our clients. I felt like inflation was slightly stickier. I didn't think that it was likely that these companies that had gotten away with higher prices were going to suddenly lower them because it wasn't really in their best interest to do so. And so I think that while we can't predict what's going to happen, we can have some reasonable expectations of what we think is likely to happen. I think that's the goal of saying, let's not try to, pick the winners in every game tomorrow. And although, we've got March Madness, but with that, I think our goal here is to figure out, all right, either way, how can we make sure that our clients are taken care of?
Yeah, that's the most important thing, taking care of clients. And I want to play a clip for you. Maria Bartolomo explored the path she believes that led to the financial crisis on her program on Fox Business. Here's her thoughts. Ben, I'll get your comments on the other side.
This is bad policy. You've had interest rates at zero for 15 years. When you have such low interest rates, people want returns. They search for yield, and they search for yield in sometimes risky places. So bad policy, rates too low for too long. And then not even a year, we see rates go from 0 to 4.5%.
Yeah. What do you think?
Yeah. So first of all, I think it's tough to lay the blame there. Let's not forget that for a while, the Federal Reserve had a target of 3%. And then they're like, inflation's too high at 3%. We're going to bring that target down to 2%. And when you had interest rates incredibly low, and we still were barely getting 2% rates of inflation prior to COVID, it makes sense why those rates were low. And then also, we all remember what happened during the Great Recession in 2008 when, interest rates went up. Well, these adjustable rate mortgages hit. People couldn't afford their homes. Real estate crashed. The economy crashed. It was one of the biggest upsets in a long time. And it took over 5 years for the S&P 500 to get back to where it was in 2008. So, look, I understand that you want to blame things on policy, and I don't have a problem pointing a finger. I'm happy to do it when it's appropriate. But in this scenario, I don't think that's necessarily fair. Although I also think that we have to, I guess, recognize that the Fed policy has been good so far. I mean, you talk about for so long, will there be a soft landing? Mm-hmm. And what we have is still a strong economy with low unemployment numbers and good wage growth numbers. I mean, the underlying core of the economy is way stronger than people want to let on. Now, that's not right for everybody, and there are definitely pockets where people are hurting way more than others. But I don't necessarily think that it takes such a hard line with saying, hey, the policy messed us all up.
Yeah, well, things like the S&P 500 doesn't affect everybody, like you said, Ben. But man, they've been breaking records this year. It's been in record highs, So that's something to consider as well. I want to remind everybody the show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. Make sure you get the How to Retire blueprint. Ben will be talking about that throughout the show. It's a comprehensive plan. There's no cost or no obligation. Find out where you are, and more importantly, where you need to be. 800-380-8985. 800-380-8985. All right, so Fox News business panelist David Asman weighed in on spending issues and the economic pictures that Americans are facing. Here's his comments, Ben.
The reason for inflation, it's not because of the corporations, as the president said the other day. It's not because of shrinkflation. Inflation is because the government is spending a lot more money than it has. We just got the figures of the past 4 months that we are in deficit. It's over $500 billion in just 4 months. You multiply that times 3, you get an annual rate of a deficit of $1.6 trillion. So we are spending so much more money than we have.
Yeah, these numbers make your head spin. So unpack this for us, Ben. What do you think?
Yeah, so this is tough. I mean, let it be known first that I am not by any means a political analyst, but right. I always look at the way that Congress and the Senate, they approach budget cuts in the same way that people look at dumpsters, right? Mm-hmm. I think they're great. I think they're important to have, just not in my backyard. Don't take the money away from something that's going to impact my state or my city or my area. Right. And that's the whole problem. Yes, there is no question that we need to cut spending. We need to get things in line. One of the things that has exacerbated the problem is that all of a sudden we are paying a higher interest rate on that debt. Anybody that had a home equity line of credit in 2021 and still has the same one in 2024 understands the impact and the increase of that interest pay. Well, think about it, instead of being on a $300,000 home, think about it being on a $1 trillion plus budget, and you understand the impact that it has on, the government's ability to spend money, and that's part of the problem. But I think that there's always a middle ground here where we can look at things that are reasonable to cut and things that are not. One of the things that has been on the table for some people has been Social Security, which should never be on the table. That's money that people paid into and are guaranteed, or supposed to be guaranteed by the government. Frankly, it shouldn't even be taxed, but it is. And so it's one of those things that, are very frustrating to have to deal with.
Mm-hmm. Yeah, I mean, you're right. Deciding what to cut and when to cut is not an easy task. You're right. It's like, okay, don't cut that in my neighborhood. We need those things. We need money for roads and improvements and all kinds of stuff. Am I right? Yeah.
Oh yeah, no question about it. I mean, and it's figuring it out. Yeah, I feel like you need a detective really to go through some of these bills and figure out where the money is actually going, because it doesn't always feel like it's getting to its intended destination. But again, not a political analyst. Nobody's asking me to look at these numbers, so I'm going to stay out.
All right, good for you, Ben. That's some wise advice. All right, the show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. Let's give you that phone number, the How to Retire blueprint. That's what it's really all about. Ben putting together that comprehensive plan for you because you deserve a more confident plan to retire. It starts by picking up the phone and punching these numbers in. 800-380-8985. 800-380-8985. Folks at Fuchs Financial is standing by, ready for your phone call. So apparently they say there's three hurdles to this, Ben. Let's talk about the 3 hurdles here.
So the 3 hurdles were higher costs from inflation, consumer debt, and lack of emergency savings. So these are things that, continue to widen the gap between the haves and the haves not. We talk about S&P 500 going up. We talk about real estate going up, and that's great for the people that have money in a 401k and own a home. For the people that do not have money in a 401k and do not own a home, again, we have a widened gap there for people that do not have those things. Higher costs from inflation, you need day-to-day goods. You're not getting the same growth in line with inflation, right? You're not getting the same wage growth that goes in line with the cost of these goods. We have a problem, which leads to consumer debt. People need certain things. It's not like people are going crazy. It's not like people are taking wild vacations when they're not making minimum wage. No, the problem is that there are necessities that people aren't able to afford that they used to be able to. So that causes a rise in consumer debt. And when people are barely making it, when they are living paycheck to paycheck, and then all of a sudden something happens like having to get a roof replaced or needing new tires because that almost cost me to refinance my house. Not really, but something happens and you don't have that emergency savings. All of a sudden, the only place to put that is on a credit card. And then you end up paying off those tires for the next 3 years at 20, 25 or 30% inflation. So all of these things kind of combine to make it very difficult for the people who are not finding themselves able to get ahead.
Yeah, I usually wait until the metal starts coming through. Once I see those metal coming through the tires, then it's time, Ben.
Right. Or, you don't change the brakes until you hear that nice little symphony in the back. It's time. So, I mean, the study, there's a study in the How America Saves 2024 report by Vanguard that said that 43% believe that the economic conditions could worsen, with 82% saying they are worried about a future recession affecting their retirement plan and savings.
Mm-hmm. Yeah, no question about that. People are concerned. I'm going to play one more clip for you before we wrap up the segment. Former White House Press Secretary Ari Fletcher weighing in the reality of the financial pressures facing average Americans.
The American people aren't feeling it. If you went grocery shopping and it cost you $50 4 years ago, and then $60, and then $65, and then $68, it's not that inflation rate is going down. It's that the price of what you're paying keeps going up. And that's what the American people know and feel every time they go to a store.
Yeah, no kidding. No kidding, man.
Right. Yeah, there's a reality that at Fuchs Financial, there's only so much that we can control. We can't control the price of groceries, the cost of milk or eggs or anything else that you want to throw an internet meme about. But what we can do is we're creating a plan. We can build in inflation. We know that things are going to continue to get more expensive, which is why we caution people on retiring where they can just barely afford their monthly expenses now. We know that 2, 3, 5 years from now, things are going to continue to get more expensive. We don't want you to just be able to survive or retire. We want you to thrive and be comfortable and really be proud of your retirement and enjoy all those years that you've worked so hard, because you deserve to be retired when you do. The way we do that is by helping you create a plan. The How to Retire Blueprint is meant to help you figure out when you take Social Security, to figure out what investments you need to generate the monthly income so that you can maintain your principal and meet your living expenses and allow yourself to go on vacation and do all the fun things that you want to do. So we figure out Social Security, we figure out the investments, we figure out the taxes, because it's not just generating the money, it's keeping the money and not paying taxes that you don't need to. And then, of course, an estate plan for making sure everything goes where you want it to. So our job is to help you figure out all of that. But we can't do any of that unless you pick up the phone and give us a call.
Yeah, absolutely. Here's that number, Ben. Great advice. 800-380-8985. Your chance to benefit from the How to Retire Blueprint. Call right now. We still have a limited number of availabilities on our calendar this week. And remember, the consultation is offered at no cost or no obligation. 800-380-8985. 800-380-8985. What are you waiting for? Nothing changes till you pick up the phone. All right, we'll take a short break. Be back with more Ben and How to Retire in just a moment. What's up next?
The retirement planning rulebook has changed. Well, a famous retirement rule of thumb might pose a threat to your bottom line in retirement, completely unbeknown to you. How to neutralize the threat, coming up.
He's letting the clock run out on his Social Security to age 70 for maximum benefits. And here comes the Roth conversion. He's locked in for income for life. He's got some outstanding coaching with that annuity plan. He's created his own pension as well, and it looks like he's going to go all the way.
Play your best retirement game. Call Ben Fuchs at Fuchs Financial, 800-380-8985, 800-380-8985.
Financial freedom is my only hope. You know who said that? Jay-Z said that, Ben. But guess what? I looked up. his net worth is $2.5 billion. I think he's okay.
I think, he had this great line. He said, I can't help the poor if I'm one of them, so I got rich and gave back, and to me, that's the win-win. And I thought, when I heard that line 20 years ago, I'm like, that is just a great line. So if you really want to help the world, you just got to make more money. No big deal.
Yeah, exactly. But, don't keep it all yourself. Spread it around. And apparently, right. He does a lot of that, too, which is actually good. He does a lot of it. Yep. Yeah. The show is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. Ben is back with us to help you take charge of your money. Ben is a certified financial planner, certified private wealth advisor, professional, and fiduciary with over 20 years experience. Of course, he is with Fuchs Financial. The How to Retire Blueprint, we just talked about it, but I want to put it out there again real quick. Here's that phone number. Get yourself started with a comprehensive plan. There's no cost or no obligation. 800-380-8985. 800-380-8985. All right, so does the 4% rule hold true? I'm going to break down the famous 4% rule and how it was used or misused and how it's become a staple of retirement planning spanning for decades. Now, we know it's important to be mindful of these general retirement rules of thumb. Some people get a little nervous when we talk about this, but let's start with the 4% rule, Ben.
All right, first of all, you know how much I hate rules of thumb, but I will explain it anyway because that is as we. All right, so the 4% rule, introduced in 1994 by financial advisor William Bentham, was pretty standard in the rollout. He theorized that retirees could safely spend about 4% of their retirement savings in the first year of retirement. Following the first year, retirees could adjust according to inflation to determine how much the withdrawal rate would be in years following. He found that most retirement portfolios lasted 30 years with some remaining intact for 50 years or longer. And the first year of retirement, you can withdraw up to 4% of your portfolio value. Let's say you saved $1 million. So with the 4% rule, you could spend $40,000 a year in the first year of retirement.
Okay. All right. So what happens in the second year?
Well, you fast forward to your second year of retirement, you adjust the percentage to reflect the inflation rate. So hypothetically, if inflation were at 2%, you calculate the withdrawal rate for the next year reflected like that. Now, I just hate this rule.
I know you do.
Why do I hate this? Thank you so much for asking,
I was
Gary.
about to ask, Ben.
No,
yeah.
It's a great question. It really is. Because it's nonsense, right? You look at 2000 to 2009. 2000, S&P went down by like 10%. 2001 down by like 13%. 2002 down by like 23%. That means that over that first 3 years, if you retired at the end of 1999, you went down by like 46%, give or take. And if you're taking out 4% of what you expected in that first year, and you've got $1 million and you're taking out $40,000, and the next year now you have, $860,000, it goes down by another 13%, and you take out another $40,000, and then it goes down by another, you run out of money. And that's the issue. And your needs don't go down just because the market does. And so saying these rules of thumb are great if you want to simplify things, but they don't actually work in practice.
Well, so how was the rule tested? And it was proven viable for a while now. But apparently it doesn't hold up at times. Am I right?
Yeah, sure. I mean, they used a 50-year period from 1926 to 1976. But that also assumed historical averages of 10.3% return on stock and then 5.2% return on bonds. I don't think that we're getting 5.2% return on bonds, and I don't think that we're averaging 10.3% return on stocks going forward. And again, every time we look at anything, and in the financial world, we look at any mutual fund, any product, any insurance, anything, it always says that past performance is not indicative of future value.
Right.
One of the things that got so many people in trouble in 2022 with bonds, that they said, hey, this 60-40 portfolio always works. It's always been great. We're going to stick with it. So having 40% of your money in bonds that we didn't expect to do well, that there's no way that they could have made a whole lot of money because interest rates were so low. They're saying, hey, we've just using this old formula. Well, understand why the formula is there and make a decision. You don't want your money in bonds. I took my clients out of bonds way less than 40%. We used other assets. We used other options. There are other ways that we can be safe outside of bonds or other types of investments that have different kind of risk than bonds. But, we have to understand the way that things can grow and not just be stuck on these old rules.
The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. I want you to get the How to Retire Blueprint. 800-380-8985. 800-380-8985. I got Ben's blood pressure up by talking about the 4% rule. Now, it's not one of your favorite things, but yeah.
Oh, really. Yeah. See, you can't see right now. Gary can see me right now. My whole face is red.
Yeah. Poor Ben's about to have a here. We're live on the radio.
I'm knocking on wood. We're going to take a deep breath. I'm going to do some meditation during the break. We'll be fine.
Okay, good. We'll take a break in a little bit, but we got a few minutes left in the segment here. So anyway, how does this apply? Now you're looking at a portfolio that has adopted an alternative asset allocation. We talked about the 60-40 split. So what do you think about that, Ben?
So he adopted the assumption that a retiree's portfolio would be invested 50% in stocks, the S&P 500, and 50% in bonds. Bonds being treasuries and middle intermediate bonds. So using this asset allocation, he tested a range of first-year withdrawal rates. A 3% withdrawal rate, all portfolios lasted 50 years. A 4% withdrawal rate, most portfolios lasted 50 years, and 10 of the 50 years examined in this situation did fall short of this mark, although they all lasted about 35 years or longer. At a 5% withdrawal rate, more than half of the portfolios were exhausted in less than 50 years, with the worst portfolios lasting no more than 20 years. And then a 6% withdrawal rate, only 7 portfolios lasted 50 years, with about 10 lasting fewer than 20 years. So he found that portfolios that neglected stock market investments did more harm than good, limiting the portfolios that had seen severely compromised and plagued with longevity risk. Also found that the 50-50 allocation was optimal if the only goal was portfolio longevity. So this is incredibly important. The takeaway here from this study is that some people are being way too conservative. Being away from stocks hurt their longevity. It is important to have a place to take money from when the market crashes. Everybody needs to have a safety net, but you also need long-term growth. And if you're not having money that's somewhere at risk, then you're really hurting yourself from a longevity standpoint. I know people that have retired at 62. They say, I want all of my money out of the stock market. I don't want to be in it. This scares me. And I say, I hear you, but let's figure out a way that you can have some money there. Let's figure out how you can have some money that's growing outside of what you need on a day-to-day basis. Because again, when you're retired, you're not taking all of your money out at once. You're not just taking all this money out of the 401k. You're not putting it all into a bank account and living off of it. You'd be doing the wrong thing. You'd be paying too much in tax. That's not how you should be looking at retirement. You should be looking at what is the money that I'm going to need for the next 5 to 10 years? And how am I generating the income to produce that need? What are the investments that I'm using? And if I segment my portfolio to those income-based pieces and the safety net behind it, right? If market crashes, the income stops producing. Where do I get my money from? That money that's left over should really be in a growth style portfolio. That money that you don't need should really be there. Yeah.
So you're balancing risk and growth. Am I right, Ben? Pretty much?
Always, right? You're balancing safety, right? Money that can't go down if the market crashes. You're balancing income, think like a monthly paycheck, right? And then growth. Those 3 things need to be balanced in every portfolio. And if you don't have all 3 of those, then it's going to be really hard for you to retire for a long time, unless you feel like going back to work and being a bag person, so sometimes, not taking risk is riskier than taking the risk.
Yeah, sometimes you need to take it. Yeah, about a minute or two left. So, what's the whole bottom line on this segment, Ben, for our listeners? What do you think?
The bottom line is that you need to have the right mix. You don't want to have 100% of your money in stocks. You don't want to have 100% of your money in bonds. You don't want to have that 100% in stocks and bonds. You want things that are alternative, that are separate, that are going to grow differently. And if you have all of your money and those 2 pieces, you could find yourself very hurt. Also, if we think about the 50-year period that they looked at, 1926 to 1976, bond rates were a lot higher over those 50 years than they were for the last 20. We had some very, very low bond rates over that time. So another key takeaway here is that just because something is a rule of thumb and it has worked effectively, you don't want to just accept that rule of thumb as is. You want to look at the mechanics behind why it worked. And what they're basing this on is kind of, research that is outdated. I would love for stocks to average 10.3%. That makes sense. But there are other considering factors. There are times when the market crashes. There's a sequence of returns risk. And it would be nice if we could average 5.3% all the time in the bonds, but we can't. So I think at the end of the day, the thing that we can offer people is a second opinion. A look at what they have. Are you taking too much risk in your portfolio? Are you paying too much fees on the investments that you have inside of your portfolio? How does what you have generate a monthly income? Does that mean you're going to have to sell off pieces of it every single month or every single quarter? Or do you have something that's going to generate interest every month? Because there's a big difference. One, you're selling off pieces of your growth every month, and the other, you're maintaining your principal, right? You're maintaining the value of your nest egg as it's generating the income off of it. And I'll be honest, I really want you to have the second. I want you to have something where you're able to generate interest, maintain your principal, and live off of that to be comfortable throughout your entire retirement. And if we can do that, we can create a plan that you don't have to worry about it. So again, we're here to help you figure out when to take Social Security, try to figure out the right investments that you need for your plan to generate the income that you need after Social Security. Figure out a tax plan so that we're not just figuring out income and the investments, but how it affects you from a tax perspective, both in the short and in the long term. And then, of course, take a look at your estate planning when it's all said and done.
Yeah, it's not a do-it-yourself situation. Too many moving parts, too many puzzle pieces. And Ben's going to put that plan together, him and his team, the How to Retire Blueprint. But it starts by picking up the phone and punching those numbers in. 800-380-8985. Claim your spot on Ben's calendar. They do fill up quickly. A limited number of availabilities. Remember, consultations offered at no cost or no obligation. So what are you waiting for? Nothing to lose, everything to gain. You deserve a more confident plan to retire. When you retire, you want to be stress-free. You want peace of mind. Not like Ben talking about the 4% rule. You want to calm down. 800-380-8985. 800-380-8985. Do it right now while you're thinking about it. All right. So we're going to take a quick break because Ben needs a break. But we'll be back with more of How to Retire with Ben Fuchs in just a moment. What's up next, sir?
Questions are important to keep in mind throughout the retirement planning journey. Like, why does Gary still keep teasing me? But I can live with that. All right. Coming up, we have 8 questions for you to ask and have answered so you can secure the retirement you deserve.
We believe in better. A better way to invest. A better way to serve you. And a better result. We can help you determine how much risk you're taking, red flags that could be potential problems for you, how much you are paying in fees or commissions, potential tax liability, or even how to address Social Security. Call Ben Fuchs at Fuchs Financial, proudly serving all of Connecticut. Call today, 800-380-8985. 800-380-8985.
Hi there. Welcome back to the show. The show is How to Retire. Ben Fuchs. I'm your consumer advocate, Gary Nolan. And back with us to help you take charge of your money. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years in the business. Of course, he's with Fuchs Financial. He's calmed down now. By the way, I'm taking the show notes from that segment, Ben. Taking the show notes, and here we go. I'm ripping them up because we're never going to talk about that again because I hate to see you so upset. I really do.
It does. It really affects me from a whole mind-body perspective. Thank you, Gary, for your consideration.
You're welcome. All right, our quote for this segment comes from 50 Cent. You have to say it like that, 50 Cent. Now, I did meet 50 once, and he was a very nice guy. Really nice guy.
Met him?
I have a picture with him, yes,
okay.
at a radio station event. So I will show you the picture after the show. I'll send it to you.
Was it you beating him in an arm wrestling competition?
No. But he had his New York Knicks jersey on, and he was ready to. He was trying to get some airplay at a radio station. So he himself, all by himself, didn't come in with the entourage. Nothing. It was crazy.
Okay. All right.
So his quote was, "Got some questions that I got to ask. I hope you can come up with the answers." So that's what we're going to do. It's important to know some basic information about your retirement and income plan. So I'm going to pose some questions to you, and Ben's going to have all the answers because he's the answer man. All right. So you may want to take notes. This is very important. So let's start with the first one, Ben. Maybe explain this to our listeners. What is my average annual return for the past 1, 3, and 5 years?
All right. So average annual return. That means for the past year, for the past 3 years, for the past 5 years. What did your IRA or 401k generate? What was the actual percentage of gain? And it's important to know this because you want to see how risky what you have is. If you got 10, 15, 20% last year, that means that you're taking a fair amount of risk in your portfolio. Because if you got 2023, 20% in terms of gain, that means you also went down 20%, 15, maybe more in the previous year. So it's important to know these things, but you also don't want to use them as a guideline going forward. It's important for you to know, but also not to rely on, because again, just because something went up 20% last year, it doesn't mean that it will do the same next year.
Mm-hmm. You mentioned it earlier. Yeah, there's that disclaimer that we talk about in the show. Past performance is not indicative of future growth. Did I paraphrase that properly?
You had it, except for that last word. Past performance is not indicative of future value. I don't know why that is, but growth makes more sense. I like the way that you did it better.
Let's get that changed. All right, so that's explaining the annual return for 1, 3, and 5 years. So what is the appropriate benchmark for my portfolio? What do we mean by that, Ben? I don't get this.
Yeah, I mean, really what they're saying is, what should I expect to generate? And this is important because one of the things that isn't talked about enough that I think really should be is what is your return per unit of risk, right? What are you getting from your portfolio versus the amount of risk that you're taking? If you're getting 5% return and taking zero risk, great, right? That's a CD right now, not bad. And if we're getting 6% return, but we're taking a tremendous amount of risk, well, maybe the equation doesn't make sense, right? Maybe you need to get a better return based on the amount of risk that you're actually taking. So your benchmark for your portfolio is really going to be determined on how much risk you're comfortable taking and when you made that investment and how long it's been sitting there, and what the goals are, because every portfolio has a slightly different benchmark, and it's important for us as advisors to make sure that we're putting your money in a place that is appropriate for you.
So how do you determine, an individual person, how do you determine how much risk they need to take or should be taking, Ben? How do you analyze that?
Yeah, well, you talk to people. I mean, it's tough. There's a lot of programs out there. There's a lot of different questionnaires out there. And personally, because you've never seen me skeptical, I think they're all nonsense. People answer these questions and then they'll say, I don't even know what I was answering. I don't even know what this means. I think what's important for an advisor to do is sit across the table from somebody and ask them questions. All right, how did you feel in 2022? Oh, I was fine. Wasn't worried about it. Okay. What would happen if you were already retired? Oh, I'd be terrified. Okay, great. Have an idea of how much risk you're willing to take. That's a gauge that we should look at.
Mm-hmm. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. Let's give you that phone number, 800-380-8985, 800-380-8985. And when you sit across from Ben, these are kind of the things that you're going to be getting answers that Ben will talk to you about. And yeah, exactly how much risk you need, where are you, where do you want to be, complete analysis of your own financial situation, a unique plan just for you. So the next question would be, have I done better or worse than my benchmark, Ben?
Yeah, this is important because a lot of people say, they like to pick their own stocks and they're great. I know a guy that had a ton of NVIDIA and a ton on Amazon, and that dude destroyed the benchmark, right? Mm-hmm. I mean, those stocks went up like crazy last year. Also, to be fair, a tremendous amount of risk. Again, anything that can go up can go down, but his benchmark typically is something like the S&P 500, and he way, way, way outperformed it. Now, we've seen a lot of portfolios with the same amount of risk as the S&P 500, but have way underperformed. And so again, this is one of those things where you want to say, hey, am I better off doing this myself or should I have somebody else help me?
Well, obviously you need someone. It's not a do-it-yourself situation, like I said, and that's why you need Ben and his team to put a plan together for you. It all starts with that plan. So no question. But do I have a risk management formula in place to protect my assets if the economy and market crashes? You already talked a little bit about this. Explain this a little bit more, Ben, to our listeners.
Yeah, so in the previous segment, we talked about separating your assets into three distinct categories, right? Having a growth bucket, a safety bucket, and an income bucket. You don't want the money that you need next month to pay for your mortgage or pay for your taxes to be in that growth bucket. It's too much risk. You want to have income that is being produced, that is generating interest on a monthly basis that you can use without having to sell anything. And if that interest is based on things like bonds or notes or anything else, you need to have a safety bucket aside from that. That formula is completely unique to everybody. It's not a one-size-fits-all. We determine it by figuring out how much money you need after your Social Security or your pensions or both from your investments. And then we create the formula based on that. And all of the advisors in the office, we all do the same thing. That's the way that we operate. And I am very specific about that because I've managed pretty much the way everything is invested within the office, no matter who you talk to, which advisor you're sitting down with.
Yeah, it's an individual. So, I mean, basically, if someone comes to you with, $200,000 or someone comes to you with $2 million, you're going to analyze the situation. You're going to act appropriately for each one, right?
No question about it. It doesn't matter if you have 200,000 or 20 million. We're going to sit down with you and figure out how we can best help you. And it's going to be totally unique for everybody. There are different tax consequences for having more money exposed to the market and other scenarios that have to be dealt with differently. But the bottom line is figuring out what you need to be comfortable and safe so that you can have a long, healthy retirement and you don't have to have the anxiety of worrying about running out of money.
You ever have a client come to you and say, okay, I need this much X amount to live, and you say, sorry, you can't do that based on what you got. You have to be honest with them, right? Exactly.
All the time. I mean, and it's not like we're trying to hurt anybody's feelings here, but you'd rather have some upfront advice than being like, oh yeah, go for it. Go ahead, retire, let me manage that money. You'll be fine. And then, hey, 5 years later, you need to get back to work. So, it's important to get that good, solid advice. I talked about it one time saying, financial advisors need to be a little bit more like doctors in this scenario. I don't want my doctor to, when I go to the physical, say, hey, Ben, everything's fine, you're great, and then just drop dead because I clearly haven't, give me the medicine, give me the advice. What do I need to do? Eat more fruits and vegetables. Okay, yes, I might know that anyway, but I still need to hear it sometimes to make the change.
Yeah, that's a shame. He shouldn't have had that heart attack. But, I never told him there's risk about it, right?
Right. Well, it's because of Gary bringing up that stupid 4% rule. Anyway.
Yeah, I know. Ben's on blood pressure thinning medicine right now.
I'm not. I'm healthy. I'm knocking on wood. Let's not risk anything. Thank you.
That's a knock on my microphone. There we go. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. I want you to get the How to Retire blueprint like Ben was talking about. It's a comprehensive plan, no cost or no obligation. So what are you waiting for? Get on the phone right now. That's where it all starts. 800-380-8985. 800-380-8985. Do it right now while you're thinking about the folks at Fuchs Financial are standing by. All right. We've got some more rules to go through here in the remaining minutes. What is my risk-adjusted return? Now, what do you mean by that, Ben?
Yeah, we touched on that a little bit earlier, and it really comes down to, how much is my return based on the amount of risk that I'm taking? If I'm only able to get 5.5% by having all of my money at risk for a 30% downturn versus getting 5% on a CTE, well, maybe my risk-adjusted return isn't that great. I'm taking way more risk than I need to versus the gain. What is the actual difference versus getting what's called a risk-free rate? So those are the formulas and the calculations that the advisors go through, but ultimately we figure that out for you.
Mm-hmm. Yeah, of course. And so, which leads to the next question. Am I being adequately rewarded for the risk I take with my investments?
Right. And this is key. And again, going back to 2022, the amount of risk that you took by having so much of your money in bond funds was not rewarded by the potential gain from owning them, right? If everything had gone well and interest rates had stayed flat or gone up even a little bit, had gone down even a little bit, you would have seen some gain in those bond funds, but you only could hope to gain maybe 2 or 3%, the interest that was being generated plus maybe a little bit of growth. But you still, a lot of people went down by 17 or 20 or 25% from some of these bond funds. So the amount of return that you were getting, that you had the ability to get, was not the same as the risk that you were taking. So in the scenario like that, no, you were not being adequately rewarded for the risk that you're taking. But, ultimately for us, these are, I would say, higher tier questions, and they're difficult questions, but that's what any advisor should be able to go through for you. How much risk are you taking? Is it appropriate for you? Are you getting the benefit of taking that risk in your portfolio? And frankly, do you need to take the kind of risk that you're already taking? Some cases, yes. Some cases, no. But ultimately, you want to meet with somebody that can create a plan for you. I don't go to the mechanic so that he can tell me how to fix my car. I go to the mechanics that they will fix my car. When someone comes to us, they want to have a retirement plan. Most people don't say, hey, tell me how to do this myself. They're saying, hey, can you just help me create a plan so that I don't have to worry about this in retirement? You guys take care of it. Send me the paychecks that I need every month, withhold the taxes, make sure I'm in the right place, and then I can relax and worry about other things. And that's what our goal is. Ultimately, the How to Retire Blueprint is figuring out how we can help you retire and take all the stress of managing this money off of your shoulders.
Yeah, absolutely. The first step is to sit down with Ben and his team at Fuchs Financial. Something we're talking about resonates with you. Maybe you feel the need to get that second opinion. We talked about that earlier, too. Make sure your plan is really aligned with your goals. Very important, risk tolerance. Spend a lot of time talking about risk tolerance in this segment, too. Just pick up the phone and dial this number, 800-380-8985, 800-380-8985. Get the How to Retire Blueprint. There's no cost or no obligation. Folks at Fuchs Financial are standing by, ready for your phone call. Nothing to lose, everything to gain. You deserve a more confident plan to retire. You want to be stress-free. You want that peace of mind. Maybe you're in the red zone right now that we talk about. So now is the time more than ever to do this. 800-380-8985, the How to Retire Blueprint. Do it right now. All right, we'll take a short break. We'll be back with more Ben and How to Retire in just a moment. What do you have up next for me, sir?
When we come back, we have listener questions and answer as many of them as we can. Stick around.
Do you ever feel like you're fighting for financial knowledge? Don't let bad advice be a punch in the gut to your retirement. Take advantage of a complimentary, no-cost, no-obligation consultation with a local, trusted financial coach.
Call Ben Fuchs and the team at Fuchs Financial, 800-380-8985. That's 800-380-8985.
Welcome back to the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. And Ben is back with us to help you take charge of your money. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years experience. And, of course, he is with Fuchs Financial. We talk about this show from time to time. We talk about the fact that Ben has many letters after his name, right?
I mean, you know, again, like I said, my eventual goal is to get so many letters that the entire show is just taken up by you reading them, and then I have to come up with fewer answers to all these questions. But, you know, we'll get there.
Yeah, but seriously, that's what sets Ben's apart, Ben being a fiduciary and having this knowledge. We talk about knowledge transfer on the show from time to time, Ben, as well, and that's what it's all about, right?
I mean, you know, ultimately, the letters all came because I never wanted to be in a situation where I was giving somebody the wrong advice because I didn't know something. And so having to go through becoming a certified financial planner, being a certified private wealth advisor professional, I mean, they're different areas of knowledge. And then the advisors on my team, Gina Mazadra, Alex Cal, Eddie Eiserman, all of them have different designations. And I think that's incredibly important because when we get together as a team to go through our clients' scenarios, we want to be able to have a different background. We want different information coming to the table. And so it was very important for me to not hire clones of me, not to get more people just like me, but to get people who have different experiences and different designations, because all the advice is coming from us as a team anyway. But we want to make sure that we're able to, I guess, broaden our reach.
Yeah, a great team of advisors at Fuchs Financial. Let's get to our questions, Ben. All right. What is your opinion of all the robo-advisor stuff I've been hearing about? Is AI taking over retirement? Should I look into it? AI, it's dangerous.
Well, I mean, look, AI is interesting. I mean, it's interesting. Our team is doing a lot of research on some of the different AI stuff, some of the different, options that you can do. I mean, you can write a book in a day, and it would save me a lot of time. But, it's all bits and pieces from other pieces that are already on the internet from what they can gather, and that's important. But I think there's some concern. So when it comes to AI in portfolios, when you show me a robo-advisor that consistently outperforms some of the indexes, then I think I'm going to be interested, right? It's not going to be a year or two. It's going to be consistently, because there are a lot of times when people can get lucky, broken clock, right twice a day. But I want to see some consistency, and I want to see some methodology and understand that. The problem is, and this is true with any big hedge fund, is that when they're doing growth and they have a strategy that has outperformed the market in the past, what happens is they get too big and the strategy stops working, or they get copycats and things stop working. Okay. And so, it works with $1 billion, $2 billion. You start doing it with $10 billion, all of a sudden you're the one that's affecting the market there. Robo-advisors, when they find a strategy that works, there are going to be a lot of other people that are copycatting that same exact strategy. These aren't unique. I mean, you can't, the only way to keep an investment strategy secret is to not tell anybody, and you can't really do that when it's code. Yeah, so, right. Yeah, I think that there are some concerns. And I think the other part is I don't want someone to be in retirement relying on AI and be like, well, that AI robot made a mistake. Oh, well, I'm sorry. I guess there was a problem with the code. You still lost a couple $100,000. Right.
And who do I talk to about that?
Right. I mean, versus like, hey, this is a strategy. This is where we are. These are the recourses. This is what we have in place. Here's the methodology to make sure that you don't run out of money. I believe, frankly, that my job is safe for a very long time because there's so much nuance that it isn't there, and there isn't necessarily one right answer. A lot of it is understanding the people in front of you and figuring out what they need and how you can best help them instead of plugging things into a formula. If I could just plug things into a formula, I wouldn't need any other advisors. You wouldn't need me. That would be great. But, until that time comes, you're still going to hear me on your radio.
Yeah, I mean, if you go to the doctor and you're examined by a robot, someone's got to determine what they see, and you still need that human touch. I think it's vitally important, Bennett. Frankly, it scares me a little bit.
I'm with you. I mean, and I think it's fair to be scared. I have a client that is a doctor, and she asked me the question about robo-advisors. I'm like, well, do I need to go in and see you, or can I just go to WebMD? Yeah. And she's like, oh no, WebMD is awful. Don't do that. I'm like, well, and not that it's awful, but don't self-medicate with WebMD. That could be terrifying. Right? Sometimes, just enough knowledge, it can hurt you more than it can help you out.
Yeah. It's interesting. Even when we record these shows, when we finish recording, a little thing pops up to AI will transcribe the complete show, and it does it like in a minute, and it also spits out a summary of the show, and it's like, I got to tell you, that's pretty slick. It looks at, it really is.
I think there's some really cool things that, instead of, if I want to chart or a graph, you can go onto some of these AI things and have them type in what you want, and instead of me trying to figure something out in Excel for 5 hours. Ooh, right? So there are definitely some options, some different things. But again, I think it's cool when I'm looking at pretty pictures. I don't think it's necessarily cool when I'm doing, when I want to base my entire retirement plan on it.
Yeah, absolutely. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. Let's give you that phone number, the How to Retire Blueprint, designed custom for you from Ben, not AI, 800-380-8985, 800-380-8985. All right, let's get to Bart in Bristol. How can I locate an investment account that I lost track of many years ago? The firm I invested with sold to other firms. This happens a lot, Ben.
This happens a lot. First you call the company that it was sold to, and if it's like one of those things where it's difficult, you call them, you go through the rigmarole, and typically you can find somebody at that company where things were sold to locate where the money is, or it went to another company. Yes, it happens a lot. Now, the other option is that you can check the Office of Unclaimed Funds within the state. So usually as part of the state comptroller, you can use the following website to check individual states. It is www.usa.gov/unclaimed-money. usa.gov/unclaimed-money. So it's a place where you can go. You can also just Google search it in Connecticut. There's a site there where you can find your unclaimed money. I think I had like $7 and an insurance refund that I didn't claim. And then, I saw the form to get that money back. I'm like, I don't know if this is actually worth the 30 minutes of time to get the $7. They can keep the $7. Maybe that was the point. But there have been situations where people have significant funds. I remember, Gary, I was working with a guy probably 7 years ago, and we were going through, and he had some old 401ks. A lot of people have these old orphaned retirement accounts where they're not contributing to them anymore. And he's like, yeah, there's one I forgot. I think it has like $20,000 or $30,000 in it.
Wow.
So I'm like, all right, well, it must be nice to forget about $20,000 or $30,000, but great. Why don't we give them a call? Because he didn't have the number. So I just tried, let's try it out. We gave him a call. We put him, the information that we needed to verify who he was. And as it turns out, he had over $200,000.
Oh, my goodness. Yeah. Wow.
And he was like, what? I'm like, well, again, these are great problems to have. Also, wow. But, I'm like, I helped you find this. I expect like a 30% finder's fee, but unfortunately it didn't work that way. But we were very happy that we could help him locate that money and make sure that he got it, and then was able to use it in a way that actually helped him for his retirement.
Yeah, you should have got the $7. That's almost a meal at McDonald's today. Almost quite.
I hate you could get 2 of my wife's coffees at a certain coffee establishment. That will not be named.
By the way, I did find an old one myself, and I found out it, and it had $1,000 in it. To me, that was huge.
Absolutely,
it really was.
Yeah. Sign me up for that program.
Yeah, absolutely. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. Let's get you the phone number for the How to Retire Blueprint, 800-380-8985, 800-380-8985. Jolene in Monroe, what are some good, safe options, maybe ETFs, to place investment funds between investments? I want to earn more money than bank interest rates when I'm holding funds in cash. What do you think?
So there are, depending on, where you hold your money, there are some pretty good money market funds that pay right around 5% now. And of course, that's subject to change, and they might replay this radio show 4 years down the road, and that'll be completely wrong. But the idea here is that it should be right around in 2024, right around 5% right now. But that's one option, and that's really for short-term money. Also, you can look at some things like short-term CDs, 6-month CDs, where, that could change 18-month depending on when you need the money. One of the things that we find often is people say, Ben, I want you to invest my money. I want to get a higher rate of return on it, but I need this money back in 9 months. Well, that's difficult. because there aren't a lot of great options out there, and there were even fewer great options back 3 years ago. When people have 5, 10 years, you can look at things like fixed index annuities. A lot of companies go out and promote these at dinner workshops, and I don't have a problem with them. I don't think that they're terrible. I just don't want all of your money in them. But a fixed index annuity is a pretty good option for safe money when you have a longer time frame for that money. Also, you have to make sure that you meet certain qualifications. You don't want to be in a position where you have way too much money in that annuity, and then you need some, and then you have to pay a penalty to get it out. That was an issue.
All right, let's see. I'm going to leave it right there, Ben. Jolene, Bart, and Frank, thank you so much for your questions. Final thoughts as we wrap up the show, Ben.
Yeah, I would say that, there were a lot of different topics that we talked about today. Some from hosts on Fox, from other issues, talking about the economy. Ultimately, we can't control a lot of that. We can't control what other people do. We can't control what the economy does. We can't control other people's rules of thumb, but we can control how you manage your retirement goals. Right? It's the whole thing. I can't control what the coach does, but I can control my attitude. This is the thing that we have control over. And so our goal at Fuchs Financial is to give you control over your retirement, to take the stress of worrying about your money off of your shoulders and let you worry about all the other important things that you want to do in your life and in your retirement, so that money is one less thing to worry about. The only way that we can do that is if you pick up the phone and give us a call, whether you just want a second opinion on what you have and make sure that you're going in the right direction, or you don't have any idea what you should do for retirement, or when to take Social Security, or paying too much in taxes, or any of those things. That's what we specialize in. All that our advisors do is work with people who are at or getting close to retirement. And so if you have a question about retirement, that is where we specialize, and that is where we can help you. But again, we can't do any of that unless you pick up the phone and give us a call.
All right. Our goal at the show here is to help you make the best decision. Just when Ben was talking about that very subject right there. So any questions about what we're talking about or how it may apply to you, maybe you want that second opinion, pick up the phone. That's where it all starts. 800-380-8985. 800-380-8985. Get the How to Retire Blueprint. No cost, no obligation. So what are you waiting for? 800-380-8985. The How to Retire Blueprint. Well, as always, we're up against the clock. The show has flown right on by. I'd like to thank everyone for listening. We hope you found the information we presented helpful. Look forward to all of you being back next week. We'll have new topics and new questions right here on How to Retire with Ben Fuchs, and promise no talk about the 4% rule next week, Ben. Not at all. I promise.
I'm going to bring it up, Gary. I'm going to bring it up. All right. Great.
Thanks, Ben. Have a great day.
You too.
Investment advisory services are offered through Foundations Investment Advisors, LLC, hereafter known as Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment, opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor situation is different, and ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio of securities, or investment strategy is suitable for any person. No legal or tax advice is provided. Please review your retirement, tax, and legacy planning strategies with a legal or tax professional before transacting or implementing any strategy discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Security Administration, any federal Medicare program, or any U.S. government agency. If applicable, we do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. All rights reserved.